Well, let's shift focus then to some corporate news. Also, Jindal Stainless had come out with their earnings earlier, where their revenue was seen higher by about 2.5%, but the margins were much lower. That was 9.3% versus 12.2% on a year-on-year basis. To talk more on their earnings and also the way forward for the company, we are joined by Jindal Stainless CFO Anurag Mantri. Good morning, Mantri. Mr. Mantri, thank you for joining us on the show. Coming first to your earnings, your margins have compressed on a year-on-year basis, but they've picked up on a quarter-on-quarter basis. So what kind of drop have you seen in your average stainless steel realizations?
See, if you see, as you rightly pointed out, that on year-on-year basis there is a margin drop, but quarter-on-quarter basis there is a 33% jump in EBITDA. So I think one has to understand the clear dynamics, because when we talk about year-on-year quarterly basis, last year, between last 9 to 12 months, the global situation has completely changed in terms of the global trade sanctions and the various safeguard duty measures imposed by US and Europe. So I think the better way to, because now the world is into world business is into a different scenarios where every country is working with the protectionism. So that's the reason what we see when we compare on a year-on-year basis, the global scenario is completely changed and it's really not comparable. But if we see on a quarter-on-quarter basis, we have made up some of the lost ground what we lost in Q2 and Q3 on account of the higher volume which we made it up. Because also there was in Q2 and Q3 there was a continuous fall in the nickel prices, which is the key underlying raw material for us, for continuous consecutive 7 months, which created a more negative inventory valuation as well as a bearish sentiment, which has recovered to an extent in quarter 4. So what we are seeing is a quarter 4 margins improving. You talked about average realization. The average realization in the quarter 4 was around 1,44,000 as compared to the 1,53,000 in the previous quarter. But I think the better way to see us is the EBITDA per ton has improved on a quarter-on-quarter basis, which is now well about 13,000, and earlier in the previous quarter it was just 11,000. So that's improved because of our consolidating our position. If you see volumes, we have gained volumes, our revenues have increased. So we have consolidated our position and market leadership in the domestic market. We are almost 55% of domestic stainless steel market. And with the demand continue to be robust on a stainless steel segment, we expect the volume to be maintained. But however, on the margin side, what we are seeing, there is a huge dumping happening by the Chinese importers, rerouting all these Chinese imports after the circumvention was put in the China. Now these imports are being rerouted through Indonesia, which we believe that there is an immediate need for protecting the Indian industry.
Mr. Mantri, we'll come to the topic on imports as well in just a bit.
Because
we'll just come to the topic on imports in just a bit. I just want to talk a bit more on the numbers, and I'll come back to the import problem, because I know that's something that's a niggling factor for the metal industry in general. Now you mentioned that stainless steel prices have seen a bit of a drop on a QOQ basis, the average realizations at least for Jindal Stainless. I want to know that for the last 6-7 months, like you mentioned, nickel and ferrochrome prices as well have been falling. Is that as well having an impact on stainless steel prices, that because input costs have been falling, you are seeing a drop come by in stainless steel prices as well? And now, like you mentioned, there's a bit of a recovery in nickel and ferrochrome prices. What is it that you're seeing in stainless steel prices?
So as you rightly pointed out, in stainless steel prices have clearly the components of underlying raw material prices, how it moves, because partly is the pass-through model. So when it fluctuates with the stainless steel prices, underlying raw material prices. In our case also there was a change in the mix in terms of the non-nickel bearing grades. What we are focusing more in the country, which will give more stability to our P&L, is that focusing on the ferritic series, which is and it's completely in alignment with the domestic demand, which is largely coming from railways and autos. Similarly, we are in a utensil segment, we'll be introducing a new ferritic grade which is of the world standard. So all this will help us the mix, which is ferritic series is typically a lower realization, but because there is no nickel in this, almost there is zero nickel in this series, as compared to the 300 series, which is a high nickel. So we may see a realization falling down, but EBITDA per ton and the volumes we should be able to maintain. Obviously, we will always talk about the imports later on, but I think this is how we should see in terms of the realization dropping because of the mix change also.
Mantri, shifting focus from earnings and all, you've exited the CDR, the corporate debt restructuring. What does this mean for your company, and also how will things change from here on the financial as well as the operational front for the company?
So CDR exit, let me just correct it with the writer that CDR exit process is right now on. The lenders have agreed and they have fixed the date for the CDR exit, which is 31st March 2019. Now because we have a group of lenders, almost 25 plus lenders, so everybody is in the process of taking their respective committees approval. But I think the good thing is that it's been settled in terms of the recompense amount has been settled. So we have settled 191 crore of the recompense amount, which has been fully provided in the P&L in this year. And also what we see now going forward, this will give us more flexibility in terms of our balance sheet and strengthening our balance sheet further, because this gives us access to the new lenders as well as the refinancing of the existing loans at a more competitive pricing, but in a medium term, not immediately it may have an impact, I think, but immediately clearly we can't see is that it's a major step. It will be a major step because then lenders are not lending into any of the debt restructured company, but on a standard company. I think that's very critical from RBI perspective.
Mantri, now let's go back to the topic you were talking about when it comes to higher imports. Now with the entire US-China trade war bit and like you mentioned, you know, the FTA agreement, etc., do you believe that domestic demand is actually now being catered to more via imports as opposed to, you know, domestic supply?
You are absolutely right, because the demand in the country is growing, but I think what we are seeing is that now, as you mentioned, that US and Europe has put up the various restriction on the Chinese imports. Now Indian government has also put a restriction on the Chinese imports, but now this has completely been circumvented, and now these imports are being rerouted through the FTA countries, the countries which India has an free trade agreement, like countries like Indonesia, Korea, Japan. So these are being just rerouted through these, which are putting pressure on the margins. So clearly we are okay with if it's a level playing field in terms of the import, but Indian manufacturer currently have two disadvantages. One is that we are one of the lowest cost producer in the world, but one is that the subsidized and dumped imports of the Chinese companies coming through Indonesia is creating a margin pressure. Second, we have a inverted duty structure on the two key raw materials, which both are not available in India. One is the stainless steel scrap as well as the ferronickel, which is actually putting a further disadvantage to the Indian manufacturer. So I think the government of India has to, what we are working with government of India to take an immediate measure in line with what US and Europe and other economies have taken to protect the domestic industry and to bring alive the Make in India effort, because this is very critical for local employment generation, giving a boost to the Indian manufacturing. Otherwise, with such a low margins business, it will be very difficult when we have a high cost of debt.
Point taken, Mr. Anurag Mantri. Thank you for joining us, giving us an outlining the earnings as well as what you expect for the sector going forward. That was Anurag Mantri, was the CFO of Jindal Stainless.